In this video, you're going to be learning a few simple hacks to set appropriate trailing stop losses when trading within the stock market. A trailing stop loss basically adjusts your stop loss as the price changes. Basically, stop losses that trail behind you like a horse trails a carriage. And I do want to start this by saying that I've never been a huge fan of actual mechanical static stop losses. I just think this doesn't accurately take into consideration the minute-by-minute movements within the market. Simply put, I personally find that if you know what you are doing and aren't driven by emotion, most of the time these stop losses are more of a barrier to success than they are a tool for risk management. And of course, there's the issue with market makers executing you out at certain popular levels of stop losses, since all stop losses are usually set to be in public. But I made a whole video on this, so I don't want to go too off topic. I put the link in the description if you're curious though. But I don't live under a rock, and the reality is that a lot of new and novice traders are probably going to be better off having some form of a stop loss. Since trading is really just a game between probability and your own emotions, hedging against emotions should help you. So while I still am not a fan of the static stop loss, I am a fan of the trailing stop loss if it's done correctly. It can be a very effective strategy for lowering your risk and maximizing your potential over the long run. So in this video, we're going to be going through some of my hacks to appropriately set up stop losses when trading. And the only thing I ask of you in return for this wonderful trailing stop loss knowledge is that you hit that ravishing like button. And of course, also subscribe for more short, sweet, and simplified videos on how to trade the stock market. Okay, so to start, I do want to say that I'm not ragging on folks who are profitably using these static stop losses. There are tons of people that stop losses fit well into their trading style. It just isn't my style. Please find a style that works best for you. I can only speak from my own experiences. So going back to the example in the intro, you know that the best entry points are upon confirmation. We enter upon a confirmation of price strength, and that allows us to ride the price strength up while measuring our strength over our blue SMA line. Now the pro of this is that you know when the position is turning against you. When you see that first break below the SMA line or more aggressively holding below, you know that you've reached a validation point which you are validated in exiting. So how does a trailing stop loss play into this? Well, the most perhaps mechanical and straightforward way to use a trailing stop loss is to simply set it to break below our blue short-term SMA line. If you are validating and exiting upon a break below our SMA line, and thus a break of price strength, then it makes sense to set a trailing stop loss to execute you out at that point. And this is sort of what I'd call trailing stop lossing for beginners. It's a decent hack for those of you who don't want to stare at the chart and wait for a break of price strength all day. But this is sort of the training wheels of the market where you're not yet confident enough in your abilities or emotions to allow yourself to manually execute out of a position upon validation. And if this is something that you are having trouble with, then by all means do go ahead and use this strategy for your trailing stop loss until you no longer have the problem. But as you get more advanced, the reality is going to switch. As you start gaining more experience in trading, you're going to start looking at validation points differently. A validation point is a point where you ask yourself, does it make sense to exit the position here based on all of the other factors? It's not just a point where you blindly exit, although it can be if you're trying to trade really conservatively. But as you get more experience, you're going to use a validation point as a point where you're asking yourself if it makes sense. Are you actually validated in exiting here? You have the validation point, right? So that's one deprecating factor, but you're going to check for everything. And I do have a trading checklist, which I'll link to below. But essentially, this is a point to ask yourself based on these factors, such as whether or not it is a good deal on the RSI, if you're trading below or above fair value, etc. You're going to ask yourself if it makes sense to sell out of the position. And if it makes sense to sell out of your position at validation, that's when you do so. And by the way, it's the same thing with confirmation points. We don't just buy in upon confirmation, we buy in when it is confirming. It is confirming what we already thought based on the other factors at hand. And when we are selling out, we sell out when we are validated in selling, based on all the other factors at hand. So with this in mind, you know that setting a mechanical stop loss at validation is one strategy, but this is for folks who are beginners and are at a stage where they can't trust themselves yet. They can't trust themselves yet to follow through with their plan. Everybody needs to have an entry and an exit point plan. This is for folks who have an entry point plan, but they don't know that they can yet trust themselves because of emotions when it comes to exiting. So they're going to be setting a exit point, a mechanical exit point at validation. If you are at this stage, absolutely set a trailing stop loss to sell you out at a break of the SMA line. If you want to be a little less conservative, you could set it so that it sells you out when you actually close below the SMA line, just so that you don't get taken out by the highs and lows for that period, aka the wicks. You don't want to be executed out of too many trades. But anyways, once you've progressed past this stage, your trailing stop loss should function to protect you from only the worst case scenarios, with your own due diligence protecting you from minor cutbacks. If I am executing a position upon price strength and directional strength above both our SMA lines, the worst case scenario for me isn't a validation point, because I could simply just sell out manually if and only if I find it appropriate. But the worst case scenario is a massive and quick drop below the directional SMA line. If I am looking for a price to continue uptrending, then a break of direction downward below our directional SMA line is a disaster. It's frankly a disaster, a tsunami of unfortunality. So we want to be able to shield ourselves from that while also keeping our ability for due diligence intact. The minute that we start relying on stop losses and mechanical tools, that's the minute where we lose the human aspect of trading, and that's the moment when we lose our analysis. And the hack with this is to simply set your trailing stop loss to execute you out at a break of directional strength below our long-term red SMA line. This allows you to make quick decisions when above the line, but protects you and automatically executes you out when you break below it. And if you want to be a little less aggressive with it, you can set it to 10% lower than our directional SMA line, so that it takes into consideration patterns of failed breakouts below it, and you don't get faked out of positions. We don't want to be executed out just because a stock has a pattern of being too giddy and breaking below the SMA line temporarily. But we do want to be executed out if the direction goes kaput. And as traders, most of the lucrative positions are going to be in an upward direction territory anyways, so this is going to be an effective way to hedge risk. Well, what about swing trades? How should we set trailing stop losses on swing trades? I know that a big appeal of swing trading is the fact that most positions don't require you to watch them all day, and thus it is easier to fit inside a schedule alongside a full-time job or something like hunting for goblins all day. But how do you protect yourselves from changes in direction, and how much is too much protection? Well, if we are looking at Tesla and are looking to take advantage of a change of direction over our directional SMA line, then we are likely buying in upon a failure to break upward direction and then monitoring it for several weeks for signs of a downward reversal. But since this is for multiple weeks, we likely aren't going to catch a massive drop if it happens quickly. On this negative earnings report, Tesla got beat down massively and broke its directional strength. So you need to declare a point at which you say enough is enough. And for many people, that would be a break of directional strength. And that would be a sufficient worst case scenario exit point for your trailing stop loss. But what I'd actually recommend is setting a price alert when you are in a swing stock that falls more than 5% intraday. This allows you to reassess the situation and then sell out before it breaks directional strength if you feel that the deprecating factors make it unreasonable to stay in the position. Okay, so what if you're in a stock that is oversold and are looking to get in at a discount that also happens to be way below the directional SMA line? Since it's trading below the directional SMA line already, you can't set it to sell out at below that. We're already there. So where do you set your trailing stop loss then? Well, if a stock is discounted or is an overreaction play, because we know every reaction in the stock market is an overreaction in one way or the other. But if you'd like to take advantage of that and you are hedging your position on the fact that it is way below what it should be trading at, then that means that being proven wrong should convince you to exit out of the position. If you enter at this point and it drops 10% or more, then your hypothesis was proven wrong, and thus you should set your stop loss to trail around 10% of your discounted entry point. But that doesn't mean you should wait until you lose the 10%. You need to use confirmation and validation to determine whether or not a stock you are entering makes sense and whether it makes sense to stay in the position. Simply buying in upon price strength and selling out upon a break of strength is effective, but if it turns against you, you're going to need to be diligent in taking your profits or cutting your losses. Well, what about something like SMSI? It ran up massively. This is what I like to call an inflamed banshee. But let's say that you discover this towards the end of the run-up and want to take a position. What point now do you set your stop loss? Well, quite frankly, it's at this point where we are so massively overextended over both the directional SMA line and the RSI that you better have one damn good reason for taking a position here. Maybe you have a specific catalyst, maybe it's an FDA approval, I don't know. But if you take a position here, you are essentially betting that whatever catalyst that is pushing the stock up outweighs all of the massive deprecating factors that I just identified. And if you are betting this, which I usually recommend to avoid, then I'd suggest making a stop loss that is at least 10% lower. If you are betting that this is going to be going up exponentially, then 10% lower should be the final point where you're like, okay, damn it, I was wrong, I'm going to exit out at this point. And if it drops really quickly, like an inflamed banshee does, they run up really quickly, and then the fire gets the banshee and they start going down. If that happens about the 10% mark, you're going to be like, okay, well, now's the time to exit out of the position, and your trailing stop loss will help you out with that. But otherwise, you're going to be managing it yourself manually. And I guess you could argue that this is a form of a mechanical static stop loss. If you're setting to a percentage of your execution price, wouldn't that just be a static number? And the answer is sort of, but this is to the execution price and not the price that you're hoping to get in at. So we're going to call it a trailing stop loss, but that may not be the fairest way to call it, but at least you know what I mean. Well, anyways, folks, I do hope that this video was helpful. Let me know in the comment section below what sort of stop loss you like to employ, or if you don't enjoy stop losses at all. If you have any questions, you can also comment below or reach out to us on our free ZipTrader Circle Facebook group. We post nightly watch lists on the Facebook group, and we also have a free Discord chat, link in the description as well. And of course, if you would like to keep up to date with all of the latest videos, make sure to hit that subscribe button for more short, sweet, and simplified videos on how to trade the stock market. Anyways, folks, I really appreciate you tuning in. Have a great day, and I'll see you in the next video.